6 months after a currency collapse, nobody is screaming anymore. The headlines have moved on, the breaking news banners are gone, foreign journalists have packed their cameras and left, and that's exactly when the real story begins, because a currency collapse is not a moment. It's not the day the exchange rate breaks or the week inflation explodes. That part is loud, dramatic, easy to see. What comes next is quiet, administrative, almost invisible. 6 months later, the collapse has already happened, and the system has started to change shape. In the first weeks, people remember chaos, lines outside banks, empty shelves, prices changing twice a day, everyone watching the exchange rate like a heartbeat monitor. But by month 6, something more unsettling sets in: normalization. Not recovery, normalization of loss. People stop checking prices constantly, not because things are better, but because checking no longer helps. A worker who used to panic at the grocery store now grabs fewer items without thinking. A pensioner no longer calculates how much their savings lost. They already know the answer is most of it. The shock fades. The damage remains. This is the phase economists rarely show on charts, because charts don't capture resignation. In every historical currency collapse, from Argentina to Lebanon, from Zimbabwe to post-war Europe, the 6-month mark reveals the same hidden shift. The system quietly rewrites its rules. Not through speeches, not through emergency alerts, through paperwork. Banks reopen fully, but they are no longer the same banks. Deposits technically exist, yet access is limited. Withdrawal caps are still in place, not as temporary measures, but as standard policy. Transfers abroad require approvals that rarely come. The language changes. What was once called a restriction is now called a safeguard. People adapt faster than they realize. A shop owner stops saving in local currency altogether. A factory manager begins paying suppliers partially in cash, partially in favors. Salaries arrive on time, but their meaning has changed. They no longer represent future security, only short-term survival. 6 months after collapse, money still circulates. But trust doesn't. This is also when inflation becomes strangely deceptive. In the early phase, prices explode visibly. Everyone notices. Governments blame external shocks, speculators, or global conditions. By month 6, inflation slows. Not because stability returned, but because demand collapsed. People have already cut back, already downsized their lives, already accepted less. Official numbers improve slightly, and policymakers quietly point to them as signs of progress. But on the street, the improvement is meaningless. A lower inflation rate on a much higher price level is still a loss, just a slower one. And this is where the first hidden transfer of wealth becomes permanent. Debtors breathe easier. Creditors never recover. Anyone who owed money before the collapse finds their burden reduced in real terms. Anyone who saved, especially in fixed income instruments like pensions or bonds, realizes too late that their purchasing power is gone, and no policy is coming to bring it back. 6 months later, the winners and losers are no longer theoretical. They are locked in. Governments understand this phase very well. That's why the most important decisions are made when public attention is lowest. Emergency powers quietly extend. Currency controls remain until further notice. Dual exchange rates appear, one official, one real, and everyone knows which one matters, even if nobody says it out loud. In Argentina, this phase created an entire parallel economy that lasted decades. In Lebanon, it split society into those with access to dollars and those without. In Zimbabwe, it permanently broke the relationship between citizens and their own currency. None of these outcomes were announced, they simply became reality. For ordinary people, the 6-month mark is when life becomes smaller. Not dramatically, gradually. Vacations disappear first, then long-term plans. Then savings goals. People stop thinking in years and start thinking in weeks. Repair replaces replacement. Informal agreements replace contracts. Cash replaces institutions. And perhaps the most damaging change of all happens silently. Expectations adjust downward. A generation that lives through a currency collapse does not forget it. Even if stability returns years later, behavior never fully resets. People hoard foreign currency, they distrust banks, they avoid long-term commitments, they teach their children different rules about money than the ones they were taught. This psychological scar does not show up in GDP, but it shapes the economy for decades. 6 months after a currency collapse, the system hasn't healed. It has adapted. And that adaptation, not the crash itself, determines who carries the cost, who escapes it, and who never recovers. Because the real collapse is not when money stops working. It's when people accept that it never will the same way again. 6 months after a currency collapse, the most important meetings are no longer televised. There are no emergency press conferences, no dramatic speeches about stability or resilience, just closed rooms, legal language, and signatures on documents that most people will never read. This is the phase where power shifts. Not loudly, but permanently. Because once panic fades, governments and banks finally have space to act. One of the first quiet decisions is always about control. Not control in the dramatic sense, tanks in the streets or martial law, but administrative control over money movement. Capital controls introduced as emergency measures during the collapse are almost never fully removed at the 6-month mark. Instead, they are refined. Withdrawal limits are adjusted, not lifted. Transfer approvals become standardized, not eliminated. Foreign currency access is prioritized, a word that sounds neutral but quietly excludes most people. On paper, the system looks functional again. In reality, it has been redesigned. Banks regain stability not by restoring trust, but by limiting exposure. Deposits are no longer treated as fully liquid promises. They become conditional claims, available when the system allows, not when the customer needs. This is how a banking system survives a collapse without ever admitting it failed. At the same time, governments face a problem that cannot be solved with speeches. Debt. A currency collapse doesn't erase government obligations. It reshuffles them. Domestic debt, pensions, bonds, salaries, becomes easier to manage through inflation. External debt becomes harder because it must be paid in foreign currency that no longer flows freely. So governments make choices. They renegotiate quietly. They extend maturities. They restructure obligations without calling it default. Words matter here. Restructuring sounds technical. Default sounds political. But to pensioners and public workers, the outcome is the same. Promises are changed after the fact. In many countries, pensions are recalculated using new formulas that lag inflation. Payments continue, but their real value erodes month by month. Retirees are told the system is still functioning, and technically it is, just not for them. This is how losses are socialized without ever being acknowledged. Banks play their own game during this phase. With lending frozen during the collapse, credit doesn't immediately return. Instead, banks become risk managers, not growth engines. Loans are extended only to entities with political importance or foreign currency access. Small businesses are left out, not because they are unviable, but because uncertainty makes them inconvenient. This creates a subtle but powerful distortion. Large firms survive. Connected firms expand. Independent firms disappear quietly. The economy doesn't collapse further. It narrows. Competition fades. Prices stabilize, but choice shrinks. And once competition is gone, it rarely returns. This is one of the least discussed long-term effects of post-collapse policy: economic concentration. Another decision made quietly at the 6-month mark involves exchange rates. Official rates often remain disconnected from reality. Everyone knows it. Everyone works around it. But maintaining the fiction serves a purpose. It allows governments to claim stability. It allows banks to value assets favorably. It allows institutions to pretend the system is normal. Meanwhile, a parallel rate becomes the true reference point for real transactions. This dual reality teaches citizens an important lesson. Rules exist, but outcomes depend on access. Those with connections navigate the system. Those without learn to operate outside it. Over time, legality and practicality drift apart. And once that gap opens, it never fully closes. Perhaps the most consequential decision of all happens without a single announcement: the redefinition of responsibility. Before the collapse, failures were systemic. Governments intervened, central banks reassured, institutions promised protection. After the collapse, the narrative subtly changes. Citizens are told they must adapt. Businesses must be resilient. Households must plan better. The system no longer guarantees stability. It offers frameworks. This shift is not accidental. It reduces political pressure. It transfers risk downward. It turns collective failure into individual burden. And once that mindset sets in, social contracts weaken. People stop expecting protection and start expecting extraction. Historical examples show how durable these decisions are. In post-2001 Argentina, capital controls shaped behavior for a generation. In post-Soviet economies, banking distrust persisted long after stabilization. In Lebanon, informal dollarization replaced formal policy almost overnight and remains embedded years later. The 6-month mark didn't end the crisis. It locked it in, because from that point forward, every adjustment is framed as reform, not emergency. Every limitation is justified as prudence. Every loss is explained as unavoidable. And gradually, the collapse disappears from memory, not because it healed, but because it was absorbed into the system itself. For ordinary people, this is the most dangerous moment, not when shelves are empty, not when exchange rates spike, but when life appears functional again, just poorer, tighter, smaller, because that's when resistance fades. And by the time people realize the rules have permanently changed, the paperwork is already signed, the institution's already adapted, and the cost already assigned. Years after a currency collapse, the numbers often look stable again. Inflation is lower, international lenders return cautiously. But for the people who lived through it, the collapse never really stopped. It simply stretched out. This is the long tail of a currency collapse, where the cost finally settles, unevenly and often permanently. The first group to pay the full price is usually the one that trusted the system the most. Savers. Not elites with offshore access. Ordinary households who followed the rules. People who kept money in local banks, contributed to pension plans, and believed that stability was a feature of adulthood. For them, the collapse wasn't dramatic. It was gradual erosion. A retirement fund that once promised dignity now covers only necessities. Fixed income instruments become symbolic rather than protective. Years of deferred consumption evaporate without a single formal default. What makes this loss particularly damaging is that it is never reversed. Governments may stabilize currencies, banks may regain profitability, but purchasing power lost through inflation is not returned. There is no mechanism for compensation, only normalization. And over time, savers learn a painful lesson. Safety was conditional. Workers experience a different kind of damage. In the immediate aftermath, wages chase prices and fail. But in the long run, something more subtle happens. Employment returns, but bargaining power does not. Informal work becomes normal. Benefits shrink quietly. Job security disappears, replaced by flexibility framed as opportunity. Teachers take second jobs. Those who remain adapt to a narrower economy with fewer paths upward. This is how a collapse drains human capital without ever announcing it. The country doesn't just lose money. Small businesses, often celebrated as resilient, carry invisible scars. During the collapse, many survive by improvisation. Credit from suppliers, family loans, delayed payments. But in the years that follow, they face a system designed for larger players. Access to credit remains restricted. Regulations tighten selectively. Informal practices that kept them alive are suddenly penalized once stability returns. Shops close without news. Local competition fades. What replaces them is efficiency, but also fragility. Fewer businesses mean fewer options, higher prices, and less innovation. The economy functions, but it becomes thinner. Perhaps the most enduring damage is psychological. People who live through a currency collapse do not forget how quickly certainty vanished. They remember waking up poorer without making a mistake. They remember being told everything was under control until it wasn't. Even years later, behavior reflects this memory. Banks are used, but never trusted. This collective memory reshapes national behavior. It reduces investment. It weakens institutions not through protest, but through avoidance. Trust, once broken at a systemic level, does not return through policy alone. Governments, too, carry long-term consequences, though not always the ones expected. Post-collapse states often become more administratively capable. They learn how to enforce controls, manage crises, and operate under constraints. On paper, they become more efficient, but legitimacy erodes. Citizens comply, but they don't believe. Rules are followed pragmatically, not morally. The social contract shifts from mutual obligation to mutual skepticism. This is why post-collapse societies can appear stable while feeling brittle. They function until they don't. History shows that very few economies fully recover from a currency collapse in the way people imagine. Germany after the 1920s did, but under extraordinary conditions. Many others did not. Argentina stabilized, but never fully restored trust. Zimbabwe dollarized, but lost monetary sovereignty. Lebanon continues to function, but without a coherent financial system. And adaptations come with trade-offs that last longer than crises. The most important truth about currency collapse is this: the event is short. What happens 6 months after the collapse determines more than the collapse itself. It decides who absorbs the loss, who escapes it, and who never recovers enough to try again. That's why understanding post-collapse economics matters. Not to predict the next crisis, but to recognize how systems change once damage is already done, and how quietly those changes shape lives for decades.